Welcome. We have seen how profitability is estimated and cash flow statements are prepared. Suppose you have multiple projects and with reliable method you have estimated the projected cash flow, projected profitability and then cash flow, and then you make a ordered list of increasing or decreasing cash flow. This is not going to give you the comfort of selecting, means whichever project shows maximum cash flow is not necessarily the best project from financial point of view, because if one project is giving you the maximum cash flow in the 5th year, whereas another project is giving you maximum cash flow in the 2nd year, you do not actually know which project is better, because time value of money is very important. So, we need to really understand what is the time value of money, and capital budgeting offers us that opportunity. The methods that are used in capital budgeting, they are particularly applies the time value of money, meaning 1 rupee today is more valuable than 1 rupee tomorrow, day after. So, how much less is the value tomorrow? That is a topic. Now, we would like to compare different projects based on cash flow. We can use net present value method, then we can also use internal rate of return or payback period method. Payback period of course does not consider time value of money. Now, why capital budgeting decisions are important, or how is it related, where is it related to? Comparing 2 or more business models can be done using capital budgeting, then comparing projects, business model as well as project. If you are selecting equipment, maybe one is labor intensive, another is say automatic or semi automatic. So, you save labor cost at one place, you save capital cost on the other. Suppose you have access to a lot of capital, maybe bank is interested to give you a loan, you have to pay interest, then you have the depreciation cost, which are going to be fixed cost. Whereas, when you have a labor intensive project, you have less capital cost. So, depreciation will be less, interest will be less, but then your variable cost is going to go up, because you have to pay a lot of wages to labor. So, when you try to compare the two, you need capital budgeting methodologies. Equipment replacement, suppose you want to replace an old machine with a new machine, there is capital implication. Wherever there are capital investment decisions, you need to apply capital budgeting methods. So, one is evaluation, you want to realistically evaluate the yield of a business, then you want to choose out of multiple business opportunities, you want to make an ordered list depending on cash flow, etc. Now, the same thing told differently, if you have multiple project opportunities, you have to really make a ordered list. Same thing again. Why capital budgeting is important? It provides insight about viability of projects, and it ranks projects on the basis of net present value. So, that gives a clearer picture than projected cash flow. It conveys entrepreneurs the merits of a business model and which business is better or best. Information is futuristic, but they are good enough to decide future prospect. One thing is always to be kept in mind, that is, these are all based on future data. So, there is hardly any model or method that can realistically estimate future cash flow. These are all based on assumption, and anything or everything may go haywire. But then, in absence of anything more reliable, we have this break even point analysis, then capital budgeting methods, which are the tools that are only available, and we have to really apply them. And so far, as long as people are using these methods, these are actually helping in decision making, because if you make a mistake and the mistake is known much later, that becomes fatal, because your sunk cost is gone and there is no way to recover that in case you choose the wrong projects. Here is an example to drive home the point. Suppose there are project 1 and 2 and your initial investment is 1000 and 1000 in both projects. Let it be 1000, say 1000. So, it is 10 lakhs and 10 lakhs, something like that. Put any unit as you like. First year you have a cash flow, positive cash flow, meaning money is coming in 600 rupees for project 1, 950 for project 2. Likewise, look at third year. In project 1 you are getting 450 cash inflow, whereas 100 rupees is going out, meaning there is negative cash flow. So, add them up, you have total cash flow of 1000 for project 1, another 1000 for project 2, net cash flow. Now, look at the final data, aggregate data. So, both projects have 1000 rupees cash flow. So, how to make a decision? So, here you have to estimate the net present value to understand which project is more attractive, and if you do that, you will find that project 1 net present value is 561, project 2 it is 633. So, you make a comparative analysis. We will talk about it moving forward. So, time value of money, the money available now is worth more than identical sum available in the future, because money earns money. You put 100 rupees in the bank, tomorrow you withdraw that money. If the bank has a scheme to pay interest on a daily basis, you get something, whatever that is. If you give that 100 rupees to somebody today and tomorrow that person returns you 100 rupees, you are poorer by that interest. And normally we call it opportunity cost. I have the opportunity to invest the money somewhere meaning somewhere risk free. Now, understand what is risk free. You invest in a project, every project has some bit of risk associated with that. You never know what is going to happen tomorrow. So, every project, that is some uncertainty. Even without that uncertainty, there is project specific uncertainty, because you make some projection that does not go the way you have made the projection. You might have made mistake in making the projection itself. Now, you have the opportunity to put that money somewhere which does not have any risk. Where is that? Maybe you put that money with Reserve Bank of India, but then Reserve Bank does not take public money in that sense. So, you have to put the money in some nationalized bank, perhaps that is, say, hypothetically speaking, that is 100% safe. Up to a certain extent, that is insured. So, you can say that it is 100% safe, but then it is not always 100% safe. Many countries are becoming bankrupt, forget about that. But then suppose you have the opportunity to invest the same money risk free at risk free rate with something. So, what now, suppose that is 10%. Now, you invest in another project and you lose that, you do not get any return. So, your opportunity cost is 10%, because you could invest that money risk free in a bank, get 10% interest, whereas you have lost that opportunity. So, that is what is opportunity cost. Capital budgeting, make comparative analysis, particularly when future outcome or future cash flow is somewhat known. So, if you are making, say, you want to purchase a new equipment to reduce your existing cost, maybe operational cost or power cost. Some of the new machines will be more fuel efficient or energy efficient. So, you might think that, okay, let me reduce the recurring expenses by installing new machine, discarding the old machine. So, if you discard the old machine, you are going to get some money back, because you are going to sell it for something, whereas when you buy something, you are going to spend some capital. What is the net capital investment? New expenses minus the cash flow that is coming in, and then how much is the regular saving. So, you make a discounted cash flow to understand whether it really gives a positive net cash flow, make a decision. If you want to expand your business, you have to make the same analysis, you know the cash flow, and then you know what is the investment necessary. You may even make analysis of several equipment. There are multiple equipments with multiple types of capital investment, types of saving of operational expenses, and also replacement. Now, two things are very important for capital budgeting. One is time value of money. A rupee today is more valuable than a rupee next year. Hurdle rate. Hurdle means, as you understand, when you are making a race, there is a hurdle race, meaning there is a hurdle, you have to cross that to really move ahead. Here also, hurdle rate means a company who is thinking of making investment in something. they always have something in mind, that is the rate of return from the project, because they are putting in capital. So, what is the rate of return on that capital, that they would like to understand. And if they have a benchmark that I must receive say 15% rate of return from this project, only then I can move ahead, that is called hurdle rate. They have to cross, the project has to cross that hurdle, meaning the cash flow of the project has to cross that hurdle, meaning the net present value at that particular rate will become 0 or positive for the project to be qualified or for the project to be selected for investment. And net present value is determined using the hurdle rate, and if the net present value is 0, then hurdle rate is the rate at which the project is returning cash. If it is more, it is returning more than hurdle rate. If it is less than 0, it is returning less than hurdle rate. So, you are not going to accept the project. So, just another example is not, I will not waste time on that. You invest, say you lend 100 rupees today to somebody, next year it becomes 110 if the interest rate is 10. So, if that person returns you 100 rupees next year, it is equivalent to receiving 90.91 rupee, because at today's rate 100 rupee next year is equivalent to 90.91 rupees today. So, you are a loser. Likewise, there are other examples you can pause and see. The same thing showed slightly graphically for change of monotony. So, you see one, suppose it is 1 crore rupees and the other one is 1.46 crore rupees. So, 1 crore rupees today is equivalent to 1.46 crore rupees after 5 years, and this is at the rate of 10%. I have estimated using 10% rate of interest. 10% at the rate of 10%, 1 crore rupees today is 1.1 crore tomorrow, 1.21 crore next year, not tomorrow, next year, next to next year, and after 5 years. So, after 5 years you must get 1.46 crore to justify giving 1 crore rupees to somebody today. That is how money appreciates. Money appreciates in value, not in value, but in absolute value, not in relative value. Relatively, it is actually reducing value, because 1 crore today is equivalent to 1.46 crore 5 years hence. That is it. Now, as we have mentioned that capital budgeting uses several methods. Most importantly, they use net present value method, internal rate of return method, payback period method. These three we will be discussing very elaborately with examples. Accounting rate of return we may not discuss much, but I have provided the formula. Average accounting, first thing is accounting rate of return at the bottom, which is average annual profit. Suppose the project goes for 5 years. So, whatever is the total profit in the 5 years, some year it may be loss, or deduct the loss, add the profit, then divide that by initial investment. Say there is no other investment in between, that is the condition. So, whatever you get, that is the, and multiplied by 100 will be accounting rate of return. Then there is average accounting rate of return. So, here also you estimate average annual profit, average book value of asset during lifetime, meaning if there are changes during the life. So, whatever is the book value of the asset divided by that. Let us move forward. So, we will be discussing these three methods. First thing is net present value method. The net present value is the equivalent amount of money as of today for various future cash flow, or maybe single cash flow in some years. So, discount that single cash flow in the future based on expected return, meaning whatever return at which we expect the money to come in. Like if you deposit money 100 rupees in the bank or 1 lakh rupees in the bank, bank will say rate of interest is say 6%. That means your rate of return is 6%, that is rate of return. To determine net present value, we discount all future cash inflows and outflows over the useful life of the asset or project using whatever discount rate or whatever rate of return that we expect. Whether it will give or not, that we will see, but we expect it to return at say 15%. So, we will discount at 15%. Now, we need to understand, for all these we need to understand the cash flow we are yet to discuss what is cash flow. We know net profit. When we talked about financial statements, we estimated gross profit, then operating profit, then profit before tax. After tax, we estimated net profit. So, we know about net profit. What is cash profit? Cash profit is nothing but net profit plus non-cash expenses that we have deducted from operating profit. We have to or from gross profit, we have to add them back, because these are not expenses, not real expenses. These are book entry, as I said earlier, like depreciation, like amortization. These are just book entries. So, cash profit is equal to net profit plus depreciation plus amortization. Suppose you have this financial statement, gross profit is 200, 2000, operating expenses 1200, operating profit is gross profit minus operating expenses 800, interest is 300. So, profit before tax is 500, then finally, you have net profit of 400. Now, what is cash profit? Cash profit is net profit plus depreciation plus amortization, it becomes 495. That is what is cash flow, positive cash flow. If you see negative value, negative cash flow. Now, what is discounting? So far we have been telling discounting. So, if suppose you have invested 100 rupees now and you get it back sometime after some time. So, the discounted net present value is the same thing, because there is no elapse of time. Now, suppose you get 100 rupees after 1 year. So, you have to discount that for 1 year. If the period is 1 year, if the period is 1 month, you can always discount. So, you need to know what is the rate of return within a month, per month return. So, if the rate of, suppose interest rate is, or say discount rate is 12% annually, then if you are doing it on a monthly basis, then every month you have only 1% rate of return. 1% plus 1% plus 1% ultimately becomes 12%. Then the period will be month basis, but normally we go for annual basis, and will not complicate the situation by going into bifurcating the period. So, no, for the time being, you know that it is annual. So, suppose you receive 100 rupees next year. So, what is the present value today? You discount that 100 rupees by your expected rate of return for 1 year. What is that? Say 100 rupees divided by, within bracket, 1 plus the rate of return with a decimal, not full. Suppose 10% rate of return means 0.10. So, 100 divided by 1 plus 0.10, meaning 1.1 whole to the power number of periods. Say now it is 1 year. So, whole to the power 1. Whatever is the value, that is the net present value of that 100 rupees. Suppose it is, you get another 100 rupees after another 1 year. So, it becomes 2 years. So, you give 100 rupees divided by 1 plus 0.1 whole to the power 2, because it is second year. That is how the formula is given. And then eventually, suppose it is for n number of years, not 5, 6, 7 years, whatever is the general, some general format of the formula is CN, meaning cash flow during nth year divided by 1 plus R whole to the power n. Then there may be some terminal value. Suppose you have some plant machinery where you are putting in capital, and then at the end you may like to sell those machines. You are not going to throw away. Whatever value you get, you call it salvage value or you call it terminal value. So, we write CT, and that also comes after n number of years. So, it is n. So, this is how the net present value is estimated, and this formula is used for estimating discounted net present value. Please note that all these plus signs and minus signs are the core part of the formula, intrinsic part of the formula. But if there is a negative cash flow, you have to put that negative sign before C1, C2, C3 or wherever the negative cash flow is happening to accommodate that negative cash flow, positive cash flow difference. Now, if the net present value is positive, you accept the business proposition. That means that the business proposition will return more than your expected rate of return. If it is 0, it is exactly equal to your expected rate of return. If the net present value is negative, it is returning less than your expected rate of return. So, you do not accept that. Now, it emphasizes on cash flow, not accounting profit. That is what I mentioned at the beginning. It is not profit, net profit, it is cash flow. So, you have to add all non-cash expenses. Some examples, suppose cash outflow. What are cash outflow? The most important cash outflow is the initial capital investment on the right, initial investment. That is a kind of a sunk cost. You invest that money in capital and you do not get, you get whatever you get, that is revenue every now and then you get the this is cash outflow. So, capital investment is cash outflow. At the beginning you may also invest some money in working capital, that is very important. Most of the people make this mistake. Some working capital also is necessary to run a business, that is also cash outflow. Then all operating expenses that are also part of cash outflow. Suppose you pay transportation cost, you buy raw material, you pay to labor, you pay for telephone, for website development, for data, whatever you pay, these are cash outflow. You pay repair and maintenance, etc. These are cash outflow. What are cash inflow? Most important cash inflow is revenue or sales. So, from sales you get money, that is cash inflow. Then you may sell some old machine at times, not always, but sometimes you sell. So, whatever money you get, that is a cash inflow. Then at some point of time you reduce cost, becomes cash inflow. At the end of the business or at the end of the horizon, your accounting horizon, when you think that this machine will go after this many years. So, at the end you may like to sell all your assets. So, whatever salvage value you get, you call them salvage value, that is a cash inflow. Similarly, working capital also will come back, that is also cash inflow. Calculation of cash flow. Net cash flow is equal to net profit plus depreciation plus amortization. Look, in other words, if you start from operating profit includes depreciation. So, operating profit minus interest paid minus income tax should be the formula, not plus. Operating profit actually reduces depreciation, because operating expenses include depreciation, operating expenses include amortization, but we are looking for profit with depreciation. That means, operating profit plus depreciation plus amortization, but then minus interest paid minus income tax is the cash flow, because interest also is to be deducted from operating profit, income tax also is to be deducted from operating profit to get cash flow, net cash flow. Now, this is very important one. We make two very important assumptions in estimating net present value. Number one assumption is all cash flows other than the initial investment occur at the end of the respective periods, meaning that if some cash flow happens on, say, in April, we consider that it is happening in the next year March, because we want to discount that money for the entire year during which it is happening. So, suppose some cash flow happens on the 5th year, at the beginning of 5th year, we are going to discount it for whole 5 years. So, we assume that it is happening at the end of 5th year rather than beginning of 5th year. Similarly, all cash flows generated by an investment project are immediately reinvested at the rate of return equal to the discount rate. These two assumptions are very important, and the formulas which I showed you is based on that assumption. Now, we have been talking about discount rate, then opportunity cost. What is this discount rate? You may say that somebody may say that risk free rate is the discount rate, because that is my opportunity cost. But then when you are investing in a project, you are taking some risk. So, you expect much more return than risk free rate. So, bank is giving you, say, for argument's sake, 6%. So, you can always earn 6% by putting your money in the bank. Why should you invest in a project which may ultimately bomb or something, you do not know. So, your expected rate of return from this project will be much more than what you are investing in the bank. So, risk and time when the money is getting returned, these two factors are very, very important when you choose a discount rate. So, one thing is your cost of capital. Suppose you are borrowing money from bank at say 20% for argument's sake. Now, you are investing that money in a project. If that project does not return more than 20%, you are going to incur loss. So, you need to expect, or the project needs to return you more than 20% to justify investing. So, there are so many parameters for deciding on choosing the discount rate. Cost of capital is the average rate of return of the company must pay to stockholders and their debtors. So many people are involved, they are getting money from different sources. Cost of capital refers to the opportunity cost of making a specific investment. It is a rate of return that could have been earned by putting the same money into a different investment plus risk premium. So, remember the risk premium is very, very important. Choosing a discount rate. So, whatever we have discussed. Now, what is weighted average cost of capital? Meaning, suppose you have equity money in the form of equity, and you expect that your equity should return 20%. Now, you have some borrowed money where your interest rate is say 10%. So, you want to return 10% to them, you want to get 20% on your money. Suppose there is another guy who has given you some unsecured loan at 30%, some urgent money that you need. So, if it is 30%, then you need to return that guy at 30%. So, there are three rates now. So, what should be the actual rate? That is where the weighted average cost of capital comes into play. What is that? That is suppose you have 10,000 rupees from the bank at 10%, you have 20,000 rupees of equity. So, 10,000 comes at 10%, 20,000 comes at say your expected return is 20%, another guy gave you 5,000 at 30%. So, what is the weight? 5,000 is the weight, 20,000 is the weight, 10,000 is the weight. These are three weights. So, like suppose W1 is the quantum of the money, R1 is the rate of return or rate of your cost or something. So, suppose 500 rupees you have borrowed from bank at 10%. So, 500 into 0.1 plus suppose your equity is 700 and you expect return of 15%. So, 700 into 0.15 plus you borrowed 1000 unsecured loan at 20%. So, 1000 into 20% divided by the whole sum of money W1, W2, W3, whatever you get, 16.13% is the weighted average cost of capital. You have to discount all future cash flow at 16.13% and not at 10%, 20% or 15%. Now, this is an example. Suppose you have an opportunity to invest 1 lakh rupees and that will give you 35,000 every year for 4 years. Your expected rate of return is 10%. So, you put that in Excel sheet. 1 lakh rupees is the initial investment. So, cash flow is negative 1 lakh. First year you are getting 35,000, discount that at 10%, that becomes 31,818. Second year you are expecting 35,000, discount that for 2 years. Likewise, the fourth year you get 35,000 whose net present value is 23,905. Add them up, including the initial capital investment of 1 lakh, you get 10,000 rupees. That means you are getting more than 10% interest, 10% return, because you have discounted at 10% and net present value is positive. That means rate of return by this project is more than 10%. You can use Excel formula for doing this, and the formula is equal to NPV within bracket. The first argument is the rate of return. Here it was 10%. So, I am given 0.1 comma, then give the range of fields where you have the cash flow except the initial cash flow. That is why it is C2 colon F2. From C2 you can see from C2 up to F2. Here it is A, B, C, D, EF. There is some mistake on the letters. So, C2 to F2 minus B2. B2 means the initial capital. A should be actually one step on the left side. So, that is why the mistake. Just when I copied the formula from Excel, so it was B2 and the net in the result comes automatically at 10,945 rupees simply. So, you can use Excel formula, but when you are in an examination hall you may not have Excel, but in real life you have Excel and you can use the formula. Now, it is so simple. Choosing estimating discount rate. So, we will not discuss so much about that, we have already done. Here is an example. Suppose you have a business, some company XYZ has been offered a 5-year contract to provide a truck for a large manufacturer. You want to provide a truck costs suppose 16 lakh rupees and you need working capital of 1 lakh, meaning day to day expenses like buying diesel, then some money for maintenance, some money to be paid to the driver for road like say toll tax or something. Then major overhauling happens after 3 years. 3 years of operation, you are foreseeing that maybe you will have to invest something like 3 lakh rupees for overhauling the truck, because you are going to run for continuously. Salvage value after 5 years, because the contract is for 5 years, you do not want to keep the truck after 5 years. After 5 years, you think that this 16 lakh rupees worth of truck will be fetching something like 5 lakh rupees. Okay, done. Now, what is your annual revenue and annual cost? Your sales every year is 10 lakh rupees, that is the agreement with the company that they will give you 10 lakh rupees every year. Cost of diesel will be 2 lakh 50,000 rupees, salary maintenance will be 2 lakh 50,000 rupees, interest on loan will be 2 lakh because you are borrowing money, say weighted average cost of capital. Should we accept this proposition? Is it profitable? If our expected rate of return is 10%, our discount rate should be 10%, because our expected rate of return is 10%, bank loan is 10%, I have some little bit of capital also there, and if I put that money in the bank I get 6%, if I get 10% I am happy. So, my weighted average cost of capital is 10%. Should we accept this? Now, these are the consideration. Initial capital investment in truck 16 lakh rupees, working capital investment upfront is 1 lakh, total outflow in the 0th year is 17 lakh rupees. What is the revenue net cash flow every year? First year sales is 10 lakh rupees, cost of diesel is 2 lakh 50,000 etc. So, net cash flow per year in the first year is 3 lakh, not every year, because in the third year we have some special expenses. You for each item you can use this formula for estimating net present value. Each we have put it in a table. So, investment in the truck is 16 lakh rupees, present value is 16 lakh negative, because we are making net present value present day value. So, 16 lakh rupees today is 16 lakh rupees. Working capital, again we are sinking working capital of 1 lakh. So, negative 1 lakh. Annual net cash flow from 1 to 5, you can use a formula and find out the 10% factor, that gives 3.791. I will show the factor in the next session. For the time being, just assume that there is a formula for estimating net present value factor, and that is 3.791. Multiply that with 10 lakh, you get 37 lakh 91,000. Salary, likewise you estimate all of them and find out the discounted, find out the factor and then discounted value. Eventually, the net present value becomes 4 lakh 15,400 negative. So, it is negative, that means the business is not promising to return even at 10%, which is my expectation. So, obviously, I am not going to go for this business. Look at this working capital release. After 5th year, you have to remember this, that working capital will be returned. So, working capital of 1 lakh rupees will be returned in the 5th year. So, the present value factor is 0.621, so we multiplied with that to find the net present value of working capital that is being returned. So, this is the formula, you can put it this way, instead of estimating the net present value factor for different cash flows, you can estimate this net present value for each and every item separately using the formula. Look at that, how we have estimated. So, we will continue this discussion in the next session. Thank you very much.